Okay, so let's forget about the daily ups and downs of the market for a second, right? We're going to
Okay.
zero in on something much bigger here. Like, what happens when the market really takes a hit?
Yeah.
A significant drop, and why that matters so much beyond, just our investment accounts.
Absolutely.
We've been going through some fascinating research on this whole connection between falling markets and the overall, health of the economy.
Yeah.
So the mission for us in this deep dive is to really understand how these market downturns act as like signals, almost like catalysts and even amplifiers
Right.
for broader economic trouble.
Yeah, I think that's a great way to put it. It's more than just like red numbers on a screen.
Right.
The stuff we've been looking at really highlights how a big market decline can set off this whole chain of events with some very real-world consequences for the economy as a whole.
Okay, so one of the things that I found so interesting in the research was this idea of markets as like
Oh, yeah.
forward-looking machines powered by belief.
Right.
It's a good way to put it.
Yeah.
So when that belief falters, right, when that optimism about where things are headed starts to crack,
Yeah.
what are some of the immediate ripple effects we start to see right out in the real world?
Well, what's really fascinating is how quickly that shift in sentiment, like you're talking about that belief,
Yeah.
how quickly it turns into like actual economic realities.
Wow.
When confidence dips, you see businesses become more risk averse, right?
Mhm.
They start pulling back on investments they were thinking about making and new projects, expansions, things like that.
Right.
Hiring freezes become more common because the future just looks a lot less certain.
Yeah.
Basically, the flow of capital that fuels economic growth that really starts to slow down, meaning businesses have a harder time getting funding for, projects and growth.
So it's almost like hitting the brakes on the whole economic engine.
It is. Yeah, it's a good analogy.
Kind of reminds me of that Confucius quote.
Oh, yeah.
When the people lose confidence, the state becomes unstable.
Right.
But the translation we have is so powerful. It's like
Yeah.
when investors panic, the economy follows.
Yeah, that's a good one.
Like it really underscores the importance of that belief factor.
It does. Investor confidence is such a key ingredient for a healthy market.
Right.
And when that confidence erodes quickly, like we're talking about, it often points to these broader economic anxieties.
Yeah.
Taking hold, like, if investors are selling off their assets in droves, it suggests they collectively expect tougher times ahead.
So it's like the market isn't just a mirror of what's happening right now.
No,
It's almost trying to predict the future.
it is.
But that very prediction can then influence the future itself.
Precisely, it's a self-fulfilling prophecy in a way.
Right.
And that kind of leads into another useful concept we came across.
Okay.
This idea of markets as narrative thermometers.
Hmm.
So, a big market drop, it's not just some random volatility, you know what I mean?
Yeah.
It reflects a changing story about the future prospects of companies and the whole economy. Wow. So it's a gauge of the overall sentiment.
Exactly.
So a falling stock market, it's broadcasting this lack of confidence from companies.
Right.
They're not projecting these huge future earnings, and that's why their stock valuations are going down.
Yeah.
But it also signals a potential pullback in how people are spending their money, right?
It does.
Because if people see their investments shrinking,
Yeah.
they're naturally going to be less inclined to go out and spend as much.
That's a very critical connection. The perception of having less wealth
Yeah.
definitely leads to more cautious spending habits.
Okay.
But there's also the banks.
Yeah.
They get much more hesitant to lend money during these times of market uncertainty,
Right.
which tightens credit conditions even further, and that can really put a damper on economic activity.
So if we connect all of this back to the bigger picture,
Yeah.
a major market correction,
Right.
like that 20% drop that our sources mentioned,
Yeah.
it's not just about investors losing some money. No, it's much bigger than that.
It's like a huge alarm bell going off.
It is a strong economic warning
Right.
that businesses pay attention to and that individuals feel.
Yeah.
And it can trigger this whole cycle, of increased caution, reduced investment, decreased spending,
Right.
all contributing to an even broader economic slowdown.
Right. So it's like this feedback loop almost,
Yeah.
where market drops lead to less confidence,
Yeah.
which then leads to actions that can further depress the market and the economy.
The vicious cycle sometimes.
Okay, so the core message here, I
Yeah.
think,
Yeah.
is that a substantial market downturn,
Yeah.
it's not just a financial setback for investors.
It's not.
It's a leading indicator, and like we said, almost an active force in shaping potential economic downturns,
Absolutely.
largely because of its impact on confidence and then the choices that businesses and individuals make after that.
Right. You said it perfectly. It's all about the interconnectedness.
Yeah.
The financial markets, they're not some isolated thing. They're deeply intertwined with the real economy.
Absolutely.
Yeah.
So for everyone listening out there, I want you to consider this.
Yeah.
How closely does this story that's playing out in the financial markets
Right.
align with what you're seeing in your own life or in your own industry?
Yeah.
Is the market narrative consistent with your on-the-ground experience?
Yeah.
Or are there some notable differences there?
Interesting.
This is a really fascinating thing to think about.
It is food for thought.
And that's it for this deep dive.
Thanks for having me.
Of course.
It's a great conversation.
Absolutely.
Really enjoyed it.
Me too.
See ya.
See ya.
Bye.